Hello all. I did my first AMA on this sub 4 years ago, and since then the market, my business, and this sub have all evolved. The increase of sophistication on this sub in particular has been impressive. This time around, I want to again provide any guidance I can, as well as some of my thoughts that I think might be helpful. Most are new, but some are copied from the last post as they still stand. Hopefully this proves helpful. All the best, Hobbs NYC. Should I invest in real estate right now? It depends what you want your real estate investment to do. It's an excellent time for market mitigation, cash flow, and maintaining upside. It's a terrible time to house hack, BRRR, and 10x. You can no longer rely on refinancing or exiting your way into larger, more properties. If you could hold, however, you have an excellent mid to long-term outlook. Should I be worried about my multifamily assets? Not if you are like the majority of people on this sub who operate assets directly or aspire to someday. If you have a stable model, you can hold and wait out any slowed rental growth and/or lowered valuations. If you are institutional or aggressive investor where you outsource, focus on growth, and have interest coming due, however, you may need to be prepared to put up cash or be forced into a sale. But what if debt keeps increasing? There is a limit to the effect of debt can have on multifamily valuations. For example, if the debt rate went to 15%, would a multifamily asset only sell for a 15% cap plus, meaning a 15% plus return per year if purchased with all cash? Of course not. There are always non-debt buyers who would be happy to take a 15% or even 10% yearly cash flow at a higher valuation. Should I consider all cash purchases? Absolutely. I don't think it's ever been a better time. If you have an operations component and/or manage directly, you can get cash flow that will protect you from market mayhem, and if the debt market eventually comes down like it did 2016 to 2022, you have an incredible opportunity to refinance then. It's downside protection with mid-term upside. What strategies are doing best right now? Conservative, small, all-cash deals. Whereas before it was impossible to get an owner to sell these assets, we're finally seeing an opportunity to buy these assets in mass. As stated in the above section, these can have exceptional downside protection, high cash flow if you operate directly, and if debt ever comes down, a great upside potential. For people that looking for long-term stable growth, this makes a lot of sense. It's the best time period I've seen in my career for this strategy. Moderate, assets that need drywall, electrical, plumbing, or anything requiring a permit. The cost of this type of work is astronomical right now. I've seen $35K plus bids per unit with poor work that takes 9 months to complete. If you can do the work yourself or can partner with someone that can, the cost can be as low as $5K a unit and done in 1/8 the time. There are a tremendous amount of owners out there still waiting on contractors, so you can take these assets off their hands, finish the work, and then hold for cash flow, refinance, or sell. Even with a higher debt and lowered valuation, there is still a massive spread here. 50% levered returns in a year are not unrealistic. Aggressive, niche, single-family home development plays. Despite everything you'll see in the headlines, there are still great profits in certain types of home development plays. For context, most new home builds are suburban-style homes that are built in mass on a 1.2 to 1.4x margin. So if home prices come down 20 to 40% plus, these developers could be wiped out. On in-town luxury product, however, where buildable lots are extremely rare, there is still a massive pool of demand for extremely limited product. The spreads on these types of projects are 2.0x to 3.0x. This gives you an absolutely massive margin of safety. There is a lot of volatility here, and it's not the best for everyone, but I think it makes sense for a small portion of a portfolio looking for more aggressive plays. What city should I invest in?
Firstly, you should always start where you have the best operational advantage. After that, consider the following. The rapid rise in housing costs in major metros has begun pushing people out. Starting about 6 months ago, there has been a major reversal in rent growth from large towards small markets. Previously booming markets, such as Austin, Phoenix, and Vegas, that witnessed incredible appreciation, are now showing decreases in rental rates, while smaller markets are getting more demand. It makes far more economic sense for a waiter, educator, city worker, medical provider, or most of the 90% of the working population making less than 100K to move to a lower-cost metro. So for every one new tech job, there are many more people who don't want the associated cost of living that come with the new employer. This all results in larger rent growth in smaller, more affordable markets, which is exactly what we are seeing. Conclusion. From a pure growth standpoint, I believe you have the best rent growth relative to entry price in smaller, more affordable markets. Where to get rental data? This is a great source for raw data polls on 200 plus. Should I third-party PM, direct management, or syndication? What do you want your real estate to do? Conservative, if you want stable cash flow with some upside potential, operate it yourself or invest in a syndication that does. Aggressive, if you want quick turns and believe certain markets are poised for large rent growth, then use third-party property management. You may not get any cash flow and are in a riskier position, but if the valuations go up, you get the most return for the least amount of work. As much as I hate to admit it, this is who did best over the last 2 years. What can I do to improve the likelihood of solid returns? Align with your broker. By getting them into the deal, you can usually get a better price. Focus on the middle market of renters. This is the majority of demand and the most insulated from market changes. Implement a tenant respect model. All too often in B/C class assets, especially in smaller markets, the tenants are not very well respected. A little can go a long way. Consider preventative inspections, holiday gift cards, accommodations for unique needs, staff training on communication, etc. Consolidate assets. Buy a 30 to 50 unit, then buy a nearby smaller assets. Run everything together for a much lower op cost. Keep the units under market. Don't chase the highest return, chase stable occupancy. Keep substantial extra cash on hand to weather any kind of storm. This will lower total returns, but also smooth them out and prevent the likelihood of needing an expensive injection. What returns are realistic? What should I target? It depends on the strategy, but assuming you are buying a multifamily asset, you could conservatively achieve a 5% cash-on-cash return in year 1 and 7% by year 2. Over the course of 5 years, this should model out to about a 10 to 15% IRR with some work and an exit, unless the debt market drops, in which case it would end probably 20% plus. The returns in good syndications are often the same or better than if you manage directly, with a lot less work, but you can't force an early sale, so there is the trade-off. Anything below these returns, and I honestly think you are better off investing in bonds, or if you have a long time horizon, the S&P 500. Should I have others invest with me? Should I invest with others? Over time, it's probably best to do both. It doesn't really matter the size, but it's more about the experience. If you take on investors, you should have a clearly articulated strategy for not just the current aspect, but the next few. 95% of my investors either came through someone who was already invested with me, or they started with a small amount and we built the relationship over time. So if you have just one asset you're looking to take down, that's not that compelling to an investor. But if you want to buy 3 to 4 multifamily assets in an area over the next few years and manage yourself, well, that's something you can build on. If you invest with others, a few quick things to look for. Minimum 8% preferred return, no catch-up provision, 7% in year 1, and an understanding of how the group can own and manage the asset more efficiently than the previous owner. I'm in college and I love real estate. I want this as a career. So what should I do next? There is no better way to learn the business of real estate than being a real estate or business owner, and I recommend starting as early as you can. Counterintuitively, if you want to build a career in real estate, don't start there. Right now, as it takes a tremendous amount of capital to create meaningful profits. So instead, consider buying a coffee shop, laundromat, car wash, etc. This will require much less money than a big real estate asset, and you can cultivate a much larger impact. Most importantly, it's going to force you to learn marketing, legal, investor relations, people management, etc., all at the same time. I believe this will prepare you far better than any job at a real estate firm.